Hey, welcome, multifamily investors. Brandon here, and I want to do a deal analysis snapshot for you. Property that hit the market, and I know there's some interest in it, and so I thought, well, this is a good one to run some numbers on because on paper, on at first glance, it looks pretty good, but when we dive into the quick numbers, it doesn't look so good. So let's jump into this. This is a two duplex deal on the same lot in Linwood, which is South Snohomish County. So you're outside of King County, just north of Seattle, and it doesn't look too bad. They're 2-bed, 1-bath units, kind of off of a busier street, but back off that street, side by side. Older picture here. I just want to give you a sense of the property. I mean, it looks nice. It's been updated. This is the updated one that they just got the $16.50 rent, I think, for last year. Got full washer dryer in the units, updated bathroom. So this is going to be the cleanest of all of the 4 units. You can see small little wall heaters, right? This one's a little more dated, but still pretty nice. Okay, this one was probably the most dated, 2015. So those are all the pictures we have, which is better than some listings. But I want to show you here 1.2 million. Okay, and it's on sewer, 2-bed, 1-baths, 768 square feet. My little snapshot. We plug in 1.2, and I did this to keep the video quick. 25% down, which is what a lot of people ideally want to do, right? When we're doing investment properties, you've got to do 25, but most of the time you need 30 or more these days to make it work from day one. Okay, your down payment ends up being 300,000, loan of 900. Rates are sitting right around 7%. Okay, we have 4 units. I like to see, these are highlighted for a reason because I like these to pop out at me right away. What is my debt service coverage ratio? Is more applicable to like commercial deals where they want to see 1.25 or better. And so I like it as a guideline, even on smaller stuff, to say, okay, what's the debt service going to cover here? And obviously you still want to have enough wiggle room there. So you would like to be above 1, and here it's only 0.77. And here's the actual rents, if you can see those, okay? And that would be running day one when you close on it, negative $1,349 a month on average. That is for a self-managed, no vacancy. So I assumed 4% on about 4 units, and I calculated that back on the pro forma because if you did bump rents or change the terms, you're going to probably lose a little. You may lose one tenant or something or have some turnover, but not from day one. They're probably happy there with their low rents. They're not going anywhere. Okay. Sorry, let me scroll down here a bit more. So we got property taxes, insurance. I'm using it from the listing itself. This water, sewer, garbage from the listing itself. No management. I'm budgeting like $50 in repairs a month per unit. So $200 for the 4 times 12 is $2,400. No new tenant fee, miscellaneous, landscaping, other, $600 maybe for that. So that's where you've got gross rents of $58.70 currently. And after your payment of $59.87 a month, you're $13.49. So then what do we want to look at here? How do we get this thing to see if we can get back to what the market is? Well, I think conservatively still, they got $16.50. I think you could get $16.95 for these. I mean, the average for a 2-bed in that area is honestly closer to $2,200, but these are probably dated. They're smaller. So I'm going to be very conservative, say $16.95. But I'm also going to assume back here, I'm going to build back some of this water, sewer, garbage of maybe $50 a unit even. That recaptures $200 a month, which is $2,400 a year, and reduces that down to $660. Now I probably should, let's see. There's still self-managing repairs, keeping all this the same. So even if you got these all up to about $16.95 and build back another $50 a unit, so they're paying about more like, $17.45 really. Now you're going to be losing $511, which is better, but still not great. I mean, we can lose on an okay deal $100, $200 a month if we know in 6 to 12 months we're going to get to positive $500 or $600 a month. But this is losing $13.50 from day one, and even once you got these turnover with some rubs, ratio utility billing, we call it, back, recapturing some of this, you're still negative $500. So this deal is a thumbs down. You would have to get it for less than 1.2, but I just know the market's, it's not going to pay much. The seller's not going to sell for much less than that for 4 units in South Snohomish County. So you as an investor are probably going to have to look at more like 35% down. Now you're putting down almost $500,000 for 4 units to maybe make not even $300 a month. So still, it's just tough. It's very, very tough. And this is what we're seeing because there's so little supply. Sellers know it, but the prices are not reflecting the rates that us investors are being quoted. So I hope that was helpful. That's just my snapshot. What I do is I call it the investment property snapshot. This is what I produce here for clients as a PDF. And then we look at what's here down at the bottom and say, is this a go or no? And so when I run these numbers and I know what matches my clients, I'm not going to bother sending this to them because it doesn't make sense. So there you have it. If you have any questions about how I run numbers, let me know in the comments. I'm happy to show you anything on any deal that comes up in our area. And I appreciate you watching.